Funding trustee sale purchases. Trustee sales are a cash business. Purchases are paid 100% cash at the moment of sale and on site. Because of this, conventional, bank-based financing is not an option. The best and most effective way to buy at the auction is, if you have it, to use your own money. Using your own money costs virtually 0% interest and the funds are immediately available. Nothing beats having your own cash. However, if that is not possible, borrowing money is always an option. Buying real estate always requires funding a large sum. Lending such large amounts of cash is risky for anyone. Funding trustee sale purchases can be done through unsecured and secured loans. Unsecured loans require awesome credit, great income, and fantastic business relationships. Most lenders will only do secured loans, no matter how stellar the borrower's credit is. Borrowing money. Because of the large sums needed for buying at trustee sales, most borrowed money used for this purpose is secured. This loaned money can be obtained prior to the auction, which means that you arrive at the auction with money obtained from a secured line of credit, or at the auction, meaning that at bidding, a specialized private lender will fund the purchase. Both ways are good. Selecting the type of lending really depends on the buyer's business relationships, specific situation, and convenience. Secured lines of credit. A secured line of credit is a prearranged amount of money a borrower may obtain rapidly from a lender. This amount of money is secured or collateralized by real estate. The real property used as collateral is of equal or greater value than the maximum amount of the loan. Borrowing money on one property to buy another property is called cross-collateralization. There are two types of secured lines of credit: institutional lines of credit, which are bank credit lines, and private lines of credit, which are lines of credit from individuals. Institutional lines of credit. These are secured lines of credit from banks. All banks have their own secured credit line programs. Generally speaking, the main advantages of this type of credit line are low or no origination fee. Basically, other than daily interest, there are low to no charges to use the money. Flexible term. Usually there is no minimum or maximum length of loan. Money can be used for as short or as long as needed. For example, if the money is used for a single day, the only charge is 1 day worth of interest. Flexible loan amounts. Usually, there is no minimum loan amount. Banks are usually willing to use primary residences as collateral as long as there is equity. This is called a HELOC, Home Equity Line of Credit. These credit lines are ongoing and open. There is no need to redo paperwork. Maybe the greatest advantage of using this type of loan is lower interest rate. There are very few disadvantages to this type of credit line. The main one is that a lengthy application and good credit are required. Having the line of credit approved early on mitigates this issue. Private lines of credit. These are lines of credit from private individuals. There are two main types of private money sources: regular individuals looking for better returns on their savings, and professional, hard money lenders. Regular individuals' money is arguably the best source of funding. These individuals want a better rate of return on their savings. They tend to be more flexible, are usually less demanding, and charge lower interest. However, the drawbacks are that these people may not have funds rapidly available. They may not understand the business as well because they are not real estate professionals and they are practically unregulated. This can lead to serious misunderstandings when not well handled. At the least, on the minimum, when working with this type of funding, do background checks and use a real estate attorney. There are excellent courses in this subject. Be well educated prior to engaging in this type of funding. Given the nature of buying at the auction, most auction private lending is through hard money lenders. These are individuals and small companies in the business of lending money secured by real estate. The benefits of working with hard money lenders is that they are professional, understand the business, and therefore have the right kind of expectations. The majority of them know the foreclosure business very well. It is easy to check their backgrounds and reputation, and they can provide funds fast. Hard money lenders tend to be very creative. Most of them are willing to negotiate all kinds of terms as long as they make sense to them. The main drawbacks of working with them are that, typically, they charge a high origination fee and interest. They only do super safe loans, secured by lots of equity, typically 65 to 70% loan to value. Hard money lenders tend to be demanding and hard pressing. They like things their way. Most of them will start foreclosing as soon as a payment is delayed. In fact, most of them have foreclosed on investors several times. This does not mean that as a group they are predatory. It means they want their principal and interest and will do whatever it takes to get it. It is a great idea to use a real estate attorney to review any out-of-the-ordinary hard money loans. Borrowing at the auction. This is borrowing money from private lenders at the time of bidding for a property at a trustee sale. This is done through private lenders comfortable with going to auctions and private lenders in the business of loaning money this way. The keys to this type of funding are to be able to take lenders to auctions and lenders safely securing the loans. There are two options for this type of funding. Taking your own lender, which can be done in any city, using a specialized auction lender that always lends at auctions. These are available for most large metro area trustee sales. Taking lenders to auction. Private lenders like certainty and are used to business coming to them. Very few of them lend at auction. The ones that do it only do it when it makes great sense to them. Private lenders go to auctions only when they are certain that they will make safe loans and will be paid for their time and expenses if there is no purchase. Since lots of sales get canceled, private lenders loaning at the auction want to be paid for the cost of time to perform due diligence on the expense of getting cashier's checks. Because of this, it is very important to develop a good business relationship with such a lender and have a pre-established arrangement. This is a good example of such an arrangement. If the lender visits the property and the sale gets canceled, the lender gets paid $250. If the lender visits the property and gets the money in hand, but the sale gets canceled, the lender gets paid $500. If the lender visits the property, gets the money, and shows up at the auction, but there is no purchase, the lender gets paid $750. If the property gets purchased with the loan, there is no charge for those expenses. Working with auction lenders. These are specialized professional lenders in the business of lending at trustee sales. These lenders are usually active in large metro areas where the volume of trustee sales justifies their effort. Typically, associated real estate agents determine the property values prior to sale, so commissions are usually charged. These lenders dominate the auction business in their area. They know the local market, know the regular buyers, and are often buyers themselves, and arrive already prepared for lending or buying at the sales. They know how much to lend and how much to pay. Depending on their terms and services, buying through them can be very efficient because, other than the act of buying, the lender's staff does the majority of the mundane work. Auction buying loan types. Lenders funding at the auction only do safe loans. To them, this means rapidly foreclosable, low loan-to-value funding. To accomplish this, these auction lenders' favorite lending instruments are land sale contracts and trust deeds. Land sale contract funding. A land sale contract is not a loan. It is an installment sale. There are excellent books on this subject. In this type of funding, the lender buys and holds title to the property. Through a recorded installment land sale contract, the investor obtains rights and possessions of the property, but not the title. The investor obtains the title to the property as soon as the contract is paid off. In case of default, the contract is forfeited and the investor quickly loses all rights over the property in a very short time. No foreclosure is needed. The benefits of a land sale contract are definitely tilted in the favor of the lender. The lender controls title and default is resolved with minimal litigation. Trust deed funding. This is lending with the subject property as collateral using a trust deed. There are excellent books on this subject. Our Short Sales A to Z seminar also presents this type of collateralization in detail. These are the mechanics of this type of funding. Together, the lender and investor pay for the property at the trustee sale and become co-owners. The lender usually does not put more than 75% of the purchase price. The buyer usually puts no less than 25% of the purchase price. The lender and investor agree to collateralize the property to the benefit of the lender through a trust deed. In addition, the investor signs a notarized but unrecorded quitclaim deed, granting all rights to the property to the lender. In case of default, the lender records the quitclaim deed. When this happens, the investor loses all rights to the property. No foreclosure is needed. At the payoff, the lender returns the unrecorded quitclaim deed to the investor and quitclaims the property to the investor. At this point, the investor becomes whole owner of the property. If you will engage in this type of funding, we recommend that you educate yourself on the subject, investigate the lender's reputation, and consult with a lawyer. This is a quitclaim deed sample. Taking the money. Trustee sales required full cash payment. Only cash, cashier checks, or certified checks are accepted. Cashier's checks and certified checks are always used because cash is impractical. The cashier checks should be made payable according to the trustee's instructions. Most trustees want the checks to be made to their name and/or bidder's name. It is important to be able to give the trustee the exact amount of the bid and not much more. Most of trustees take more than a week to return any overpayment. This is not pleasant when paying high interest. The best way to make the funds is to have an array of checks that would allow flexible bidding. This means 1 or 2 large checks, 2 or 3 medium checks, and several small checks the size of the minimum bid increment. This is a good example. Minimum bid, $165,000. Maximum purchase price, $172,000. Option 1. Take 1 check for $165,000, 5 checks for $1,000, 4 checks for $500. It is inconvenient to take too many small checks because the bank charges the same amount for each check they print, so taking too many small checks can get expensive. Option 2. Some bidders, in the interest of discipline, take only 1 check for the maximum amount to bid. If the bid is lower than the check value, they wait for their refund.